Car dealerships do not need to steal from you to keep your finances stuck. Most of the time, they only need one thing, for you to focus on the monthly payment instead of the total cost. That is the center of the trap. You walk in asking, "Can I afford this car?" The dealership slowly turns that question into, "Can we make the payment look survivable?" Those are not the same question. The Federal Trade Commission tells car buyers to get the out-the-door price in writing before visiting the lot and before talking financing. That means the full price before financing, including taxes and fees. Why does that matter? Because once you start with the payment, the dealer can move the price, the interest rate, the trade-in, the loan term, and the add-ons around until the monthly number feels comfortable. You think you are negotiating a car. In reality, you are negotiating a stack of hidden variables, and the dealership understands that stack better than you do. The first move is the long loan. A 72-month or 84-month loan can make an overpriced car look affordable because the pain is stretched across 6 or 7 years. But the longer the loan, the more interest you pay, and the more time you spend underwater. The FTC warns that longer loans may lower payments but make the overall deal more expensive. That is how a car becomes a financial ankle weight. The payment fits today, but the contract follows you through job changes, rent increases, insurance hikes, repairs, and every other money goal you were supposed to build. The second move is negative equity. Millions of drivers owe more on their cars than the cars are worth, and many do not discover it until they try to trade in, refinance, or sell. In the first quarter of 2026, more than 3 in 10 trade-ins carried negative equity, with an average deficit above $7,000. That deficit does not disappear, it gets rolled into the next loan. So the new car is not just financing the new car, it is financing the old mistake, the new vehicle, the taxes, the fees, and sometimes the add-ons, all inside one larger monthly payment. That is why someone can trade a car and feel like they are starting over while mathematically moving deeper into the hole. The dealership calls it a solution. Your balance sheet calls it compounding backward. The third move is the online price that is not really the price. In 2026, the FTC sent warning letters to 97 auto dealers over deceptive pricing concerns. The warning letter listed practices like advertising prices that exclude required fees, using rebates not available to everyone, requiring dealer financing for the advertised price, and advertising vehicles that are unavailable or non-existent. This matters because the internet price is bait if the final price changes after you are emotionally committed. Once you have driven to the dealership, test-driven the car, and pictured it in your driveway, your resistance drops. The fourth move is the add-on trap. Gap policies, service contracts, window etching, paint protection, anti-theft devices, tire protection, reconditioning fees, and document fees can all appear after the car already feels chosen. The FTC says add-ons are not free, and it is okay to say no. It is not okay for dealers to tuck add-ons into your deal or lie about them. The problem is that add-ons do not feel expensive when they are financed. A $2,000 product becomes $30 a month. $30 sounds harmless. Over the loan, it is still $2,000 plus interest. The fifth move is financing control. Dealer financing can be useful, but the dealer typically profits from arranging it and may not always offer the best deal. That is why pre-approval matters. If you already know your APR, loan term, and borrowing limit from a bank or credit union, the dealership has less room to turn confusion into profit. Without pre-approval, the finance office becomes a second negotiation after you thought the first negotiation was finished. You are tired, you want the keys, and every document starts to blur together. The sixth move is urgency. The car might sell today, the rate might change tomorrow. The manager supposedly approved the deal for now. The monthly payment is only good if you sign before leaving. Urgency is powerful because cars are emotional. People do not just buy transportation. They buy identity, relief, safety, convenience, and the feeling that life is moving forward. Dealerships understand this. That is why the process often keeps you there for hours. The longer you sit, the more likely you are to accept a deal just to end the pressure. The seventh move is hiding the real cost of ownership. The payment is not the cost of the car. The payment is only the loan. Insurance, fuel, maintenance, registration, repairs, parking, and depreciation come after. A car payment that already strains your budget becomes dangerous once insurance renews higher, tires need replacing, or one repair turns into a credit card balance. Auto finance lenders themselves are watching affordability pressure, negative equity exposure, delinquency migration, payment behavior, fee disclosures, and consumer complaints. That tells you the stress is not imagined. Americans owe roughly $1.7 trillion in auto debt, and repossessions have returned to levels not seen since the Great Recession. The car market is not just expensive, it is fragile. Repossession is the part buyers do not imagine in the showroom. You picture the new keys. The lender pictures collateral. If the payment fails, the car can disappear, but the debt may not. In Australia, ASIC recently warned about high-interest car loan traps, large fees, high-pressure sales tactics, and cases where borrowers were left owing money even after repossession. That matters even outside Australia because the pattern is universal. When people need transportation badly, lenders and dealers can package desperation into payments that look manageable but age badly. Another trap is conditional financing, sometimes called spot delivery. You drive home thinking the deal is finished, then the dealer calls later and says the financing did not go through unless you accept worse terms. By then, the old car may be gone, the new car is already in your driveway, and emotionally it feels harder to unwind the deal. That pressure can make a higher rate feel like the only realistic option. Then there is payment packing, where the monthly payment has room for add-ons before you clearly agreed to them. The number sounds close to what you expected, so the extra products hide inside the payment. This is why you ask for an itemized contract and compare it to the out-the-door price you received before the finance office. If a product, fee, or warranty appears late, pause the deal. Confusion is not a reason to sign. The dealership does not need you to be reckless. It only needs you to be slightly optimistic. Optimistic about overtime, optimistic about future raises, optimistic that nothing expensive will happen for the next 7 years. But life does not wait for the loan to end. Rent rises, groceries rise, insurance rises, tires wear out, jobs change. A payment that was barely manageable at signing can become impossible 2 years later. So the defense starts before you ever step on the lot. First, decide the maximum total price, not the maximum payment. If the only way the car works is a longer term, the car does not work. Second, get pre-approved from a bank or credit union. Third, request the out-the-door price in writing. Fourth, separate the purchase price, trade-in, financing, and add-ons into different decisions. Fifth, say no to any add-on you do not understand. If it is valuable, the dealer should be able to explain the price, the benefit, the exclusions, and whether it is optional. Sixth, never roll negative equity into a new loan unless you understand exactly how much old debt is being buried inside the new payment. That one move can keep you stuck for another decade. Seventh, sleep on the deal. A legitimate car will still be a legitimate car tomorrow. If the deal only works while you are tired, pressured, and afraid to leave, that is not a deal, that is leverage. The brutal truth is that dealerships make money when buyers confuse affordability with payment size. A smaller payment can still be a bigger financial problem if it hides a longer-term, higher APR and more debt. Your car should help you get to work. It should not quietly absorb the money that was supposed to become savings, investments, emergency cash, or freedom. Before you sign, ask one question. If this car did not make me feel successful, would the math still make sense? If the answer is no, the dealership is not selling transportation, it is selling permission to stay stuck. Comment the worst car dealership fee you have ever seen, and if this saved you from one bad signature, subscribe for more money truths that protect your future self.